Today's Candid Conversation. We've got a very interesting program ahead. Again, my name is Mark Romoff. I'm President and CEO of the Canadian Council for Public-Private Partnerships. And as always, at the outset of these sessions, I'd ask you to please mute your computers and your phones, and that'll enable us to ensure that we get the very best audio quality for our call today. And again, I'd like to encourage everyone to think about questions they might want to ask Doug and Andrew Lin, and I'll talk about Andrew in just a moment, after the presentation part of today's session. Again, for those of you who are joining our call via computer or your app, you'll notice in the top right-hand corner of the screen, there's a quote bubble. And as you know, if you click on that bubble, you can chat directly with the entire group of participants, or you can send a question to me directly, which I'm happy to then ask of Doug and Andrew. And if you'd like, you can also ask questions directly. So simply unmute your device when you're ready to do that. And I'm happy to entertain those questions too. And as always, our hope at the Council is that these sessions will continue to be a source of both valuable information and networking for our members. And we look forward to continuing to bring you some truly outstanding speakers over the coming months. And the format for today's session is going to be a little bit different. We're mixing it up. Our guest presenter, Doug Turnbull, who many of you know, is Vice Chairman and Country Head for Canada at DBRS Morningstar, will be tag teaming with Andrew Lin, his Managing Director of Infrastructure, Power and Utilities. So that'll be very interesting. And following the process will be following Doug's opening remarks. He and Andrew will have a virtual sit down together, and they'll have the chance to discuss in a bit more depth some of the observations Doug will be making in his opening remarks. And then after that, we'll open the floor for questions from everybody who's on the line for today's call. And as I say, think about those along the way. And I know that both Doug and Andrew are keen to take on your questions. So let's get going. As I say, many of you already know Doug. He is Vice Chairman and Country Head for Canada at DBRS Morningstar Credit Ratings. And this guy's got an incredible CV. We only have so much time, Doug. I have to pick and choose here. But in your current capacity, Doug is responsible for day-to-day operations in Canada, but he's also part of the executive team. So he focuses on the strategic development of DBRS Morningstar's global rating business and senior outreach activities for the company. Doug doesn't look it, but he's got more than 35 years experience in this investment banking, and many of you know him from his days as Deputy Chairman at TD Securities. He's worked in Toronto, Tokyo, New York, and he's been an advisor to governments on corporate infrastructure and public sector issues with his clients. He's also chair of the Canadian Digitally Foundation, the Canadian Foundation of Economic Education, and Provident Healthcare Foundation. And I mean, many of you know also that he's been very actively engaged on boards with public sector and not-for-profit organizations, Metrolinx, the Ontario Financing Authority, George Brown College, Toronto Financial Services Alliance. So he's got a pretty impressive background, including one that I'm very keenly interested in, which is his co-chair of the Canada Assembly of First Nations Joint Working Group on Resource Development. Is that all, Doug? Is there no more? I thought there would have been. And as quickly on Andrew, who, as I mentioned, is Managing Director, Infrastructure, Power and Utilities at DBRS Morningstar. Good to have you here, Andrew. Andrew leads the Infrastructure Project Finance and Utilities rating teams at DBRS globally. And before joining DBRS, Andrew was head of project finance at Billfinger Project Investment, where he structured and managed the financing for Billfinger's infrastructure developments across North America. He's also held a number of senior management positions at Infrastructure Ontario and spent 10 years at Borealis Infrastructure, leading and managing transaction teams to acquire infrastructure assets. Pretty impressive background for both these fellows. Andrew, by the way, is also a grad at University of Waterloo. Me too. Good choice there, Andrew. And also has an MBA from York University's School of Business. And for all of his quality skills, he also is a sessional lecturer at Schulich's School of Business. So we have two unbelievably talented individuals that will make up the team that's going to present to us today. So I'm going to turn the microphone over to you, Doug, to kick us off, and then we'll move on to a sit-down session with you and Andrew. Over to you, Doug.
Terrific. Thank you, Mark. I fear that with that introduction, it's going to be all downhill from here, but nonetheless, we'll try our best to make this entertaining and informative. Welcome, and thank you to everyone for joining us. Mark has asked us to spend the next 15 or 20 minutes providing some commentary about how we've operated in this pandemic, what impact the pandemic has had on infrastructure and project finance transactions, and provide insight onto what we see in the coming year. We'll then throw the floor open to Q&A. As Mark said, I'm joined on the call by one of the more important voices in the credit rating industry for P3s and project finance, my colleague, Andrew Lin. Andrew is responsible for our project finance and infrastructure credit rating teams, and he's well known to many of you on this call. As Mark outlined, clearly has extensive experience in the space. Andrew and his team provide credit ratings and ongoing coverage for 91 infrastructure and project finance issuers around the world in a wide range of assets, including airports, hospitals, ports, toll roads, energy, and transportation, to name just a few. This past year of living and operating under incomparable circumstances has tested the business world's operating assumptions and business practices. Balance sheets have been stressed for both private and public entities as operations have been forced to close, demand and revenues have collapsed, and at the same time, supply chains and labor market shocks have occurred. On the bright side, apart from a brief period last March, capital markets have performed relatively well. And to date, we've avoided the market disruptions witnessed after the market crash of 2008, 2009. And I would say financing for all asset classes has been readily available and is relatively cheap. Of course, it remains to be seen what the long-term consequences will be in a world awash in exceptionally low-cost money. And a return to more normal interest rates and asset values seems to be a long way off. But it is fair to say that we're in uncharted waters, and policymakers and economists will be thinking hard about how economies return to some form of balance in the coming years. Here at DBRS Morningstar, we've been exceptionally busy since the pandemic hit over a year ago. The pandemic's impact has been felt across our entire universe of issuers, both in rating actions, upgrades and downgrades, as well as industry commentaries and analysis. Over the past year, we've had 367 rating actions, 167 trend changes, 113 under review with negative implications, and 87 downgrades across all sectors. In addition, we've published 266 pandemic and COVID-19 commentaries on topics ranging from government finance, both at the sovereign and sub-sovereign levels, banking and insurance industry, structured finance, oil and gas, real estate, autos, aviation, toll roads and ports, as well as infrastructure and project finance assets. Among public infrastructure and project finance issuers, we've taken 17 rating actions, including 4 downgrades and 1 upgrade in infrastructure, 2 downgrades and 2 upgrades in project finance, and 3 downgrades in utilities and independent power projects. I emphasize that these figures are only for publicly rated entities, as we also provide private credit ratings for various projects. It's fair to say that at DBRS Morningstar, we've learned that the vital importance of outreach of our credit ratings opinions, commentaries, and analysis to issuers, investors, debt capital market desks, and regulators has never been more important. Meanwhile, entities like Infrastructure Ontario and Infrastructure BC, to name two agencies here, have remained busy with a robust project pipeline of health and other social projects, water and wastewater, as well as various transportation and civil projects. At the same time, the new administration in the United States is focused on rebuilding critical infrastructure in that country, which will no doubt have implications for Canada and Canadian entities. With that brief introduction, let's get right to my conversation with Andrew. Andrew, let's start with getting your perspective on which type of infrastructure entities have fared better or worse through this pandemic.
Great. So first of all, I'd like to say thank you to both Doug and Mark for giving me the opportunity today to wear a shirt and tie. It has been almost a year since I've had that opportunity. And I look forward to the opportunity to, at some point in the future, wear pants as well. But that said, in terms of the last year, it's certainly been a bit of a crazy year. And the sectors that I take care of in terms of infrastructure, you have to break them out into two different groups. I'd say one where there's a strong contractual obligation by the public sector counterparty. And those ones, these are primarily like social P3 type of projects. And these ones where there are long-term concessions where as long as the operators commit to their obligations for constructions, operations, and maintenance, it's been fairly steady in terms of those type of finances because the government entities have maintained their payment structures. However, when we think about those other type of infrastructure assets that are more subject to volume volatility, so what we call volume-based infrastructure, these are like the volume-based toll roads, the airports, the ports, sectors that we cover. They have experienced a certain amount of stress. Last year, when all of this happened, we provided a webinar, and the webinar was called Planes, Ships, and Automobiles. And it was just starting to get into the pandemic. It was around the May time frame, but we could already see at that particular point in terms of airport traffic, especially in Canada, down by 90%. Toll road traffic as well, down by between 50 to 70%. Because everyone was staying at home. The container port traffic did decrease as well, but this is one of those type of situations like in the pandemic where a lot of the core business of the economy still continues on. And so even though container traffic was down due to lower consumer demand, it wasn't down as much. And so it was more the airports and the toll roads that really suffered the most because they were more subject to discretionary type of spending. So there was a little bit of a difference there. Now that we're a year into this now, we did expect at that particular point that there would be a pretty good bounce back, especially on the airport side in terms of air traffic. That actually has not happened. We were looking primarily to other jurisdictions like China, where you see a pretty sharp snapback in terms of air travel. But the difference there was that they didn't experience the same sort of second wave and third wave that we did. And they were able to control the pandemic better than a lot of Western countries. And because of that second wave and third wave, because of the closure of borders, that has really put a dent in terms of the bounce back projections that a lot of the airports that we talked to have made. And so as a result, in terms of toll roads and airports specifically, we have taken a fair number of written actions in that particular sector over the past 12 months. Doug?
Thank you. Let's turn to the other big area of responsibility that you have, and that is project finance. How's that evolved since the start of the pandemic?
Yeah, so project finance for us, just to make sure everyone understands the difference here, we define project finance as more energy related. So in terms of all the power generation assets, whether it be the more fossil fuel side of coal, gas, or nuclear, and then the renewable side as well. That's kind of the traditional project finance in the sector. But project finance also spans among all a whole bunch of other bespoke type assets, anything that you can put into a project finance vehicle. But analogous to what's happened in the infrastructure sector, those projects that had long-term, steady contracts have done fairly well, right? So you've got like a solar farm or a hydro plant, it's got a long-term 20-year PPA. It's effectively immunized from a lot of the pricing pressures, supply and demand pressures outside of that particular project. You're really just looking at the counterparty risk, and for a large number, the vast majority of them, they're really the counterparties are pretty stable utilities. That said, there are other projects that are subject to volatility. We do rate a few merchant power projects. And in those ones, we have found, similar to the infrastructure side, with the decreased demand for power, you've got power prices that have, wholesale power prices that have gone down, and therefore decreased revenues for those type of merchant power type of projects. So same sort of theme though, where you have projects that are not underpinned by strong contractual framework. They were susceptible to the downturn in the economy because of the pandemic. The other category are the ones that did have a stable contract, but the counterparties themselves suffered some issues. Now, I mentioned that you can apply the project finance framework to things that are not just power projects. So we actually rate a few pipelines in which the counterparties are actually large oil and gas companies. And when I say we rate it as a pipeline, so we rate the pipeline as a project because all of the risks are passed on to those shippers. And insofar as the shippers themselves have ratings downgrade, that would actually affect the project finance pipeline asset itself. So we have had a couple of those type of instances where they had faced counterparty risk.
Thank you. The other thing that we thought about in planning this call was the impact of the pandemic on public finances and public institutions. We have to assume that government balance sheets will be severely constrained for a number of years to come. I guess we wonder, will there be an increased willingness of governments to consider new and innovative ways to finance and build public infrastructure? What may happen as existing projects face funding pressures? And I'm thinking about the recent example of Laurentian University here in Ontario and how that might apply to student housing or parking projects, for example, on campus. And I guess the question I think about is, will we see a shift in priority candidates for P3 projects by governments who likely will face revenue shortfalls while also seeing increased demand for public or social infrastructure? And I guess in thinking about that, a current example might be with new leadership at the Canadian Infrastructure Bank, what appears to be a fresh mandate, particularly around the Aboriginal community's need for water and wastewater and broadband. Andrew, how do you think the market will respond with all of those events happening?
Yeah, well, certainly government balance sheets, whether it's at the sovereign level or at the sub-sovereign, like the provincial level, even the municipal level, have taken a massive hit this year, and it's going to take them many years to kind of crawl out of that. So when you think about funding for a lot of the initiatives, there's just so many infrastructure needs that remain even before the pandemic continues to remain. But the balance sheets of a lot of governments are in a much worse situation. So there's certainly a lot of need to think of innovative ways to try to finance these. I would say though that the P3 format, insofar as trying to generate cash flows that are already existent, user pay type of frameworks under a P3 structure really requires users to pay, really requires revenues. And in the absence of that revenues, it requires then those straight availability payments from the government, which then goes back to the whole problem of the government really doesn't have a lot of money. So I would differentiate between the core strategic assets of a country. And I would say that notwithstanding their stressed balance sheets, their stressed wallets, that they will continue to pay directly to help support them. Now, it could be through an availability payment under a P3. It could be through direct financing. I think those are the easy ones. If that asset is classified as a very strategic type of asset. I think when you go outside of those strategic assets, then it gets a lot more difficult to try to finance them. And I have to say that the P3 structure is not a solution for everything. It can't solve all the problems. And you mentioned about Laurentian University. The core problem there is the lack of revenues. And under a lot of the public universities in Ontario, what has really saved a lot of them have been the private sector in terms of private or international students and the cash flows that they're able to provide. And certain universities are much better than other universities. Case in point, the University of Toronto, with its international reputation, can garner a lot of attention from international students and the revenues. And unfortunately, another university like Laurentian, with a much slower profile, is not able to get that same sort of interest and that private funding, so to speak. And so that's going to be a tough problem, because when you think about a P3 project, and you mentioned like housing or parking, a lot of that all depends on generating cash flows. And that comes back to the same problem. If it can't generate those private cash flows, it will have to go back to the government to get a straight financing, not looking at some sort of P3 format. You mentioned though the Canadian Infrastructure Bank, and it's an interesting player within the whole P3 infrastructure world, because its mandate is really trying to bridge the gap between the other players within the capital markets to try to make a project more viable. And whether that's writing a check that is somewhere in the capital structure that's not quite the senior debt that the lenders want to lend, that's not quite the equity or the project co-equity that the infrastructure funds want to invest in. I think that the Canadian Infrastructure Bank, there are a lot of opportunities to make things happen by putting in a level of funds in capital structure where they don't need to require the same sort of commercial returns that a private sector entity would do. And all of this benefits the province and the country, because that means an acceleration of that type of infrastructure. So, this is something that the CIB has been trying to focus on. To be frank, they have been slow off the mark since they have been created. But the pandemic is maybe an opportunity as well, because it provides a lot of different assets or projects that fit into their bailiwick in terms of their mandate to fund and to accelerate projects. So we look forward to what they can do there.
I don't know, Doug, if maybe I can just interject for a moment, because when it comes to addressing the infrastructure challenges that Indigenous communities around the country are confronting, it's obviously serious. And so I was actually very pleased to see that Minister McKenna mandated the Canada Infrastructure Bank to actually dedicate $1 billion to supporting infrastructure projects with Indigenous communities. And again, given your own interest with respect to the Assembly of First Nations, the Council's commitment to working with Indigenous communities, I'm just wondering what DBRS's overall perspective might be with respect to the CIB's mandate with Indigenous communities, and where and how you might interface with the bank as they move ahead with their mandate.
Yeah, certainly we've seen a lot of discussions, and even the CIB have come to us asking our opinion, consulting with us, as well as several of our banking contacts. And there are a lot of opportunities, whether it be with wastewater or roads or power transmission and distribution networks up north. A lot of the core infrastructure that we depend on, or we just take for granted in the southern part of Canada, those are things that still need to be built out. And that concept that I mentioned about CIB being able to step in there and potentially fund in a part of the gap in the capital structure that would entice the private sector to invest debt and equity in it. I think that's I think there's a lot of promise there. Ultimately, though, a lot of those projects still rely on some level of revenue support from the government. So it could be a combination then of the old-fashioned availability payments to some sort of gap funding by the CIB, all of that to make things work. We also hear about the ring of fire over in Northern Ontario, and that's where both the commercial world and in terms of mining and extraction can play a part in helping to build infrastructure. And you can see where you have infrastructure that can serve multiple purposes, and therefore there's greater efficiencies to be used there. So the ring of fire, that gets brought up at various times over the past few years. But as the CIB is able to step up with its new Indigenous Aboriginal mandate, I think that there are more possibilities that open to make at least road infrastructure up north a greater possibility.
Mark, I would say my voiceover on that is that there's probably never been a better set of circumstances, notwithstanding that governments are spending a lot of money to deal with all the current pandemic challenges. There's probably never been a better opportunity to have both the resources at CIB in place, the experienced resources in place, aligned with a federal government mandate. $1 billion will disappear pretty quickly, but with a federal government mandate that recognizes the dire needs, just in water, wastewater, and broadband, just to pick three sort of big themes. So I think the time is right, and I think we are going to see some projects, and I think you'll see a willingness from the credit rating agencies to take a very thoughtful approach of trying to figure out how these can be rated in an appropriate fashion.
Yeah, I agree with that. And I mean, there are also other opportunities now where it's not only about Indigenous infrastructure challenges, but it's increasingly about Indigenous communities that are increasingly looking at becoming investors in projects that are beyond just their own particular geography. Obviously, The All Seasons Road, the Tlicho project up in the Northwest Territories, good case in point. I think you know that one well, where Kiewit is working closely with Indigenous communities. They've made a significant investment in that project. So that one's very interesting. And while it's early days, the Alaska to Alberta rail project, if it gets its footings, is another very significant project that has leadership coming from Indigenous communities. So I think the world is changing from that perspective, and I think it presents what I think are really positive opportunities all around. I'm not sure if it's a view you share, but I know it's very much on our radar these days.
It is a view I share, and I noticed one of the callers is Scott Northey. There's nobody in this country that knows this space better than Scott, and so
right.
I'm sure he would echo your comments. I wonder if we can now spend a few minutes on the renewed commitment in the United States to infrastructure. In all likelihood, and I would say in contrast to the previous administration that seemed to have endless infrastructure weeks almost every month, the Biden administration will probably follow through on their stated intent to build new infrastructure across America. It's expected to be broad-based, roads, bridges, broadband, other digital, and it's expected to be nationwide in scope, and it's expected to also involve tribal governments. They don't use the term indigenous, but tribal governments in the United States. There's lots of delivery challenges given Republican opposition, given the questions of how given the pandemic and all that entails. And I guess the questions I would have is, what impact will this have on Canadian infrastructure players? What impact will it have on increased competition for both resources and capital? Will the US government look to other jurisdictions for new ideas? I'm thinking about Australia's asset recycling model of a few years ago. In the Financial Times last week, Gillian Tett wrote about the concept of blended finance. And Andrew, this kind of goes back a little bit to your comments a few minutes ago, where public money is used to provide a safety net for the private sector to finance projects that might be seen to be too risky, or perhaps could be used as credit insurance or a first loss backstop. We do have a few instances of that in Canada. I guess, Andrew, I might just pick at this a little bit more and ask, is this a viable concept, and what types of projects would you see this being used for, in addition to First Nations projects?
Sorry, this is specifically about the first loss backstop concept. Is that right?
Well, or other tools that where there's a role for the federal government to take some portion of loss, or to price their loss differently than the private sector to entice private sector to come to play.
Yeah, I think that a lot of the projects that would be considered borderline really do need more capital, but they don't want that cost of capital. And really, sure, this is a kind of a new concept, but it's not really a new concept. Think about TIPIA in the US, where it is a form of senior debt financing, but the interest rates on it are really quite low. And there are certain specifics about it. It's not quite like a subordinated debt tranche, but it is meant then to increase or to better the economics of the other parts of the capital stack. Now, obviously, it's not quite a first loss piece insofar as the government still wants to get its money back, but it's able then to make the overall economics of a project work where it did not. Now, the traditional first loss piece would be more like, you were thinking more like a structured finance transaction with different tranches, and the government was to fund the very bottom tranche, where they had a very small likelihood of getting back their money. I can see that happening in some specific cases, some strategic cases where not getting their money back at all would be okay because there was a really strong greater good argument there. But in most cases, remember, even the CIB, or whether you talk about CIB or EDC or BDC, these are all financial institutions that need to track their capital. They have to account for their capital. They may not need to account for a specific commercial return, but they pretty much do need to get their capital back because they do need to recycle that. So I would make the differentiation in terms of the concept of putting in or investing into a project and getting a below market return compared a first loss type of investment where you could actually lose your investment. I think the first one is probably more politically palatable than the second one, unless there was a very strong public good or social good aspect to it.
Thank you. Thinking about the United States, I've noticed that some of Canada's strongest players, and I'm thinking groups like Axiom, Brookfield, Plenary, Fengate, for example, have developed a growing presence in the United States. What risks do you think Canadian governments face in executing their own projects should the US become the dominant North American jurisdiction for P3 activity in the coming years? And I would say, as promising as that looks, we've kind of been here before, and we know that there are all kinds of issues around states' rights and ideology and other things that have hampered the the building of infrastructure in the United States, but it's looking promising at the moment. I wonder if you can just comment on that.
Sure. And we have a lot of people online here who are part of the infrastructure industry, and so most will understand when I say that the infrastructure sector is really a global sector in any case. So whether one country is experiencing a huge number of deals in the pipeline versus another industry, this is a global industry, and Canadians have been good in playing that global game, whether it be on the investment side, the development side, the construction side. I think that it is inevitable that the U.S. pipeline grows and it will become larger, potentially significantly larger than the Canadian side. It's just a matter of numbers. They are a much larger country, and therefore they also have potentially a lot more larger infrastructure deficits as well. And so there's going to be a lot more opportunities there, and therefore Canadian stakeholders and players are going to be migrating down there. Now, what does that mean, though? To your point about what does that mean for Canadian governments who are still doing their wave of P3s? There probably is going to be a bit of tension there because the industry will look for the best returns, the best risk-adjusted returns, and the best opportunities to deploy their capital. But it's not probably not that simple because, as you know, President Biden has this America First policy as well as Trump. He wants to make sure that a lot of that business goes to Americans as opposed to non-Americans. So we'll have to see how that plays out and how strong a policy that will become. But I'm pretty sure that the Canadian players will find opportunities, whether it's in the U.S. because they seem to be now starting to get on board with the concept of P3s on a national basis, or whether it's the next country down the road in terms of new P3s. It is the nature of this industry that the same players that go from one country to another country, depending on which nation is getting on the bandwagon for doing more P3s. That said, when we have talked with a lot of the developers and contractors, we also noticed that they feel the need to diversify. So as opposed to just social P3s or civil P3s, a lot of them now have very expansive, just pure project financing arms, branching out into the renewable sector or other type of non-power type assets. And so there's a need, once you've actually created an infrastructure fund or a development fund, to keep feeding that pipeline, to keep getting deals. And certainly the P3 world in Canada, on a relative basis, it can be seen as relatively small, given the size of Canada. The P3 industry in the US, it can be a lot bigger, but right now it's still growing. And so a lot of companies have chosen the strategy of trying to diversify into other type of vehicles that can use their expertise in terms of developing infrastructure like assets and expanding the concept and definition of infrastructure to be able to work in those other sectors.
Mark, if you'll just indulge me with one more question, and then we can kick it open. I don't want to let this session go by without having just a brief conversation about ESG. And for many that might not know this, we're now part of the Morningstar family. One of our sister companies is Sustainalytics, which is a global leader in ESG initiatives around the world. It's a Toronto-based company also, another one of those neat Canadian success stories. Andrew, you've recently published a commentary entitled ESG Risk Factors for Renewable Energy Project Finance. And I should also say that you've been heading up the DBRS Morningstar approach to ESG analytics and incorporating that into our credit rating process. So you've been the think tank here on how we think about that within the corporate side of our business. I wanted to ask, what role do you think ESG will play over the next few years? And is this something that governments and project sponsors and investors will increasingly take into consideration?
Sure. ESG is a very broad term, and when people think about ESG, a lot of people look at it from the viewpoint of sustainable investing or responsible or ethical type of investing. And you're right that it is becoming a very big thing now, especially in North America. But to be frank about it, North America is kind of behind the ball on that. ESG has been a big thing over in Europe. It's only now starting to gain that type of momentum in North America. When we think about ESG, there are different ways to approach it, and you can see that right within Morningstar itself, because Sustainalytics, our sister company, looks at assessing companies based upon its the sustainability factors of the company, what it does and how it affects the environment. Our friends over on the equity research side of Morningstar Inc., they take a look about how ESG factors affect the valuation of the companies that they recommend in terms of the share price and the net present value, future cash flows that are due to ESG are positive or negative, and how that might impact the equity valuation. From DBRS Morningstar's point of view, we as a credit rating agency, we take a look at ESG from the viewpoint of credit risk factors. And that is then, as opposed to how Sustainalytics takes a look at it, Sustainalytics is looking at about how a company actually affects the world or affects society. We're taking a look at it more internally about how do these factors affect the company? How does the world affect the issuers that we rate? So a lot of it has to do with risks. It has to do with, could be regulatory risk, it could be carbon risks, it could be reputational risks that are coming, it could be governance type risks. And all of these things then feed into our credit analysis. And so we've kind of articulated that in our new ESG criteria, our approach to ESG that we published earlier in February. Now, it's important to understand though that these are not new factors that we are now suddenly considering as part of our ESG or as part of our credit analysis. I like to say that it's more that we are disclosing it better, we're making it more transparent and more explicit. So whereas before we're taking a look at all these factors in more of an implicit way, now it's more of an explicit way. As part of that, we are also disclosing then where these ESG factors are significant enough that they would have impacted the rating. So either they move the rating level or they have caused a trend change on that particular rating. And this would be published in terms of our press releases once we confirm or assign a rating. So Doug, you're right that there's a lot of interest in this, and what we wanted to do then as part of this commentary is look at sectors that I'm responsible for, and the renewable sectors is one of them. We wrote a commentary that came out just a few days ago that talks about specifically the renewable sector, hydro, wind, and solar, and what are the factors from an environmental, social, and governance aspect that we consider when we're looking at these particular issues that we particularly rate. You know, not to be pessimistic, so granted, a lot of these are risk factors, and so they could have a negative impact. But in some cases, they could have a positive impact. So again, when you think about renewables, well, what's the potential upside there? Is in some jurisdictions, they could potentially earn more from potentially greenhouse gas credits because for displacing greenhouse gases. So it's not always negative. Sometimes it is positive. But you know, we are going to be collecting more and more data as time goes on, and how our various analysts and various teams take a look at each one of these issuers and delineate then these ESG factors as we go about that.
So watch this space. There'll be a lot more on our website about that over the coming months.
We're obviously got a problem there with somebody. We're getting a little bit of interference there. I think that's better. I was just going to say that I think this is a really positive development. I mean, the fact that ESG is now becoming an important factor for credit agencies in their own rating process is good news, because as you know, there's so much being said these days about ESG, EDI, profits versus purpose, and it's some of those are buzzwords at the moment. But I think as the credit agencies take this on as a serious factor in your assessments, that I think enhances the credibility and relevance and timeliness of things like ESG. So I see that as a very positive development. So thanks for that, and I'll be interested, Andrew, in having a look at your paper. We're getting close to the end of our time, but I did have one or two other questions, and I know that there are questions coming in now. Just one, if I could sneak in. I'm just wondering, Doug, whether you're seeing any specific initiatives in other jurisdictions related to climate change and renewables. We haven't talked about that, and things there that you're seeing that Canadian governments should be considering.
Well, I'll let Andrew speak more knowledgeably. I would say that the impact of climate change is evident, but it's added to the urgency for governments to not think of it as a crazy ideology of the left, but in fact, it's a very real impact on real assets and real infrastructure. I would say that that I think it's going to drive a huge demand for data and for interpretation of data. Historic data might not be relevant in a climate change world that is rapidly changing. And so I think that that's going to also have an impact on proponents of projects that have very long asset lives.
Okay, thanks.
Yeah, there are two things. One is obviously the green bond market has been growing every year, and that kind of reflects the interest in the market for that. Now, again, green bonds is more on the sustainability side. It's not something that we as a rating agency rate, but actually our cousins over at Sustainalytics would do that. But green bonds, again, has been very big over in Europe, and now there's been a lot more issuances in the US, and even Canada is also increasing its issuance of that as well. But aside from that, I just want to talk about the TCFD. And the TCFD is the task force for climate-related financial disclosures. And this is an organization that is trying to persuade companies themselves to acknowledge and disclose their strategies and their risks to climate change. So again, it's not so much about how these companies affect the climate. This is more about how the climate is affecting the companies and what are the risks that it's imposing on these companies. And what the TCFD is proposing is that a lot of these companies provide disclosures in terms of what the risks are and what sort of things that they're doing to mitigate those risks. So issues about adaptation in terms of their critical infrastructure. What sort of stress testing are they doing? What sort of scenario analysis that they are doing to prepare for a globally warming climate? So there is a push for standardization of these type of disclosures, and I think that that's going to be the next big thing with respect to climate change. It's more about how the companies are reacting to them, and from a investor's point of view, more financial disclosures can only be a good thing.
Thanks, Andrew. It's a good point. Doug, you gave a shout out earlier to Scott Northey, so I think that pumped him up to ask a question. He's written here, in comparing two companies and with all the things being equal, could a substantially better ESG assessment result in a better credit rating for the stronger ESG focused company? And would it be a boost in one rating or a discount on the other?
Mm-hmm. Andrew, over to you.
So thanks, Scott, for an interesting question. And I'm going to interpret the way that you have said something. When you talk about a better ESG assessment, I'm going to interpret that you mean ESG from the viewpoint of sustainability, responsibility, ethical approach, because that's what a lot of people are asking with respect to a question similar to this. That is, if a company is doing good and it's actually benefiting the world or society, do we, as a credit rating agency, see that as some sort of credit positive? Let me answer that in a kind of a wishy-washy way. I would say it depends, because it's not so much that what that company is doing to help the world. It's about what then the feedback loop is of going back to that particular company. So for instance, if they're cleaning up the environment as part of what part of their production process, let's say they're an resource extraction company, and let's say that they're cleaning up the environment after they're done with it to a higher standard than what the regulators actually require. There is probably on a short-term basis greater cost, but when you anticipate that the regulators, the government will eventually be requiring higher and higher standards, they will be already prepared for that. And so it's more about not so much what they're doing specifically for the environment, but more about how either customers, regulators, or other stakeholders perceive them and are willing to give them some sort of benefit. Same thing from a reputational point of view, whether it be, say, banks. For instance, if banks has a great diversity at its core, looks to lend money to on social housing purposes, and is willing to do a whole bunch of these things, and then garners a much better reputational image. That in and of itself, its better image does not translate to a better rating. But insofar as that better rating garners more clients, more customers, and increases then its business, its revenues, that's where that feedback loop then comes back to have a credit impact. Now, mind you, a lot of times that doesn't happen, right? So you've got some mines or oil and gas companies where they actually specifically look for jurisdictions where the environmental cleanup requirements are actually not that high. And so are we, as a credit rating agency, when we're looking at the financial lines, the revenue lines, the expense lines, trying to look at their EBITDA numbers, if we find that it really doesn't take them all that much money to actually dump their waste somewhere, and there's no penalty for that, and if that regulator there doesn't penalize them for that, that may not be good from a sustainability point of view. Sustainalytics would probably not like them very much, but from a credit rating point of view, all we see is its top line numbers. It's pretty good from a profitability point of view. So you've got to take a look at it from that kind of angle. We're looking at it purely from the viewpoint of how does it affect the financials, and there are lots of cases where doing good in and of itself does not make it good from a ESG credit risk point of view, from a rating agency's point of view.
Okay. I have one last question. I know we're right at the end of our time here, but if it's possible to have a brief answer to this one. I have a question here about given government funding challenges, what do you see as the potential for the reintroduction of the potential for private sector involvement in Canada's airport system?
That's a good one. Now the airport sector is one sector that we have been quite active in. We rate the Toronto airports, Airport de Montreal, Vancouver airports. We recently dropped our rating on Edmonton Airport, but all of those airports have suffered significantly. I think the issue right now is that when you see volatility like that, especially on a pandemic or a recession, and the air traffic is quite correlated to GDP. You can see here's a good example where a lot of these airport authorities in these times of need are looking to the federal government for financial support. If you translate that into the private sector, if it were all privately owned, these private owners would not have the same sort of balance sheets that could be available from governments. They may not have the same sort of long-term view and the social good aspect from governments to be able to fund these airports on a long-term basis. So I think that obviously as infrastructure funds, they're always keen to invest. I think though from a political point of view, there would be a lot of pushback from travelers certainly, potentially from airlines, from communities that rely on those type of connections to have privatizations, because a lot of people really do appreciate having the government and the government balance sheets behind these airports. These are considered, when I was talking about strategic infrastructure, so even in times of financial distress or financial stress for governments, I think that these are the type of strategic assets that the government will always stand behind.
Okay. Thanks, Andrew. I apologize, gentlemen, but we are absolutely out of time. So let me, first of all, take a moment to thank you both. Really appreciate your opening remarks, Doug, and the opportunity to engage both yourself and Andrew in a really interesting conversation around issues that are really a high priority for folks, and that's clear from the questions that we've been receiving. So thank you for making the time available today. If we're able to get, I think we've been circulating, Andrew, your ESG report to everyone that's participating in this session. That's great. Hopefully that'll generate maybe some inquiries of you directly. So once again, thank you, Doug. Thank you, Andrew. Great to have you here today. And I enjoyed the different format that we used today, and hopefully folks on the line did as well. I just wanted to mention that our next Candid Conversation will take place on Wednesday, the 7th of April. As you know, we're doing it every Wednesday, first Wednesday of the month, rather. And our guest speaker on the 7th of April will be Sam Chai, who many of you know is president of Kiewit Canada Development Corporation. So that should be a very interesting session as well. So thank you again, all of you, for participating today, and have a great rest of the day. Thank you very much. Thanks again, Doug, Andrew. Bye-bye.